With me today is my colleague, Jeff Krumpelman, who is the Chief Investment Strategist as well as the Head of Equities for the firm. Jeff, thanks for joining us.
It's great. Glad to be here, Katrina.
We're glad to have you. Before we jump into some of what I mentioned previously and jump into the details, obviously we have some slides presented that we plan to go over, but I thought, Jeff, if it's okay with you, I might just make a few comments to really just kind of set the stage and maybe do a little bit of a recap that takes us from January until now.
Sure.
Perfect. All right, so first and foremost, I thought I would just mention, that it's been a really great year for equity investors. The moves that we've seen in the market have been both strong and broad. If you look across virtually all segments of the equity markets, whether that's domestic, international, both small cap and large cap stocks. And on this front, back in January, we expected double-digit returns in the S&P 500. We had initially set a target on the S&P 500 of 4150. And so if you think about that back at that point in time, that meant that we anticipated a 13% total return in U.S. large cap stocks for the year. So obviously we thought we had a positive outlook on things. And that said, as we sit today with the S&P 500 sitting right around 4,300, we must admit that we're a little surprised at just the strength and the swiftness that we've continued to see here in this bull market, but certainly won't complain about it. And so, as you look back at what we were thinking back in and at the beginning of the year, we were probably more positive than some other folks out there, but we were also hesitant to be more positive than we were at that point in time. If y'all remember, there were several things that we were looking for and monitoring at that point. Obviously, one was the COVID vaccine distribution plan and whether or not that really played out as expected. There was obviously also the contested election and any challenges that might bring, as well as just seeing, fiscal and monetary policy, how that would get executed as we tried to bridge the gap into a transition of a broader, more comprehensive reopening of the U.S. economy. And so these critical items have been managed much better than any of the worst case scenario outcomes that were being talked about and thought about from us back then. And so here we sit amidst some of the most, the strongest economic growth that we've seen in decades. We're seeing really strong earnings cycle, and the S&P 500 is sitting above our optimistic case for the year. And so we're really pleased that our messaging back then was to stay invested throughout. That continues to be our message today. And we may have underestimated just the swiftness of the upward move that we've seen. We do feel good about getting the trend right. And for those of you that have joined and listened in and read a lot of Jeff's writings, you know that we focus a lot on the trend and feeling that that's one of the most, getting the trend right is one of the most important components of really achieving good investment outcomes. And so we do expect the market to advance over the course of the next 12 months. Although that being said, we also would not be surprised if we see a correction. When you think back to the lows last year in March of 2020, we've seen a 96% advance in the market, which is huge, it's great. But that also means when you take that and you compare it to some of the wall of worry items such as inflation and the impact that may have on Fed policy, there's also just fear over potential tax rate hikes in 2022. And then there's just some general angst around economic and earnings data peaking. And so we don't see an evidence of a market top, so we will be taking up our target on the S&P 500 over the next 12 months, but just think it's important to point out that we won't be surprised if we see a correction, and certainly don't want any of you to be surprised or fearful if that does come to fruition. So Jeff, as I think hopefully my intent of that was just to kind of set the stage, help us form a productive conversation for everyone here today. But I'd ask you, are there any other important points that you think would be helpful to make in framing up returns that we've seen so far this year?
Well, I'd be a fool not to say that was a brilliant executive summary, Katrina. So, no, I mean, I think that was really a great summary. I do think, and you've got this slide that's queued up, and I guess here I'm kind of keeping you honest in terms of you went through a lot of numbers and you said it's been strong and it's been broad. And so this just kind of brings that to life and you see the numbers. So for example, if you look domestically, S&P 500 through mid-year up 15.3%. You've got the Russell 2000, so small mid-cap stocks, up 17.5%. So domestically, things were, very, very strong and robust. And I'd say even within the domestic kind of stock market, you had, again, breadth within sector, breadth within style that might be a little underappreciated. Everyone was reading about tech stocks and with rates backing up a little bit that they started to cool and had a moment of swoon, in the spring a little bit. But they had a marvelous June. They were up 8% in the month of June alone, up nice double digits. So they participated too. And this whole idea of the, the battle between growth and value, we're actually now at about parity between growth and value. And so, our message throughout had been balance. And I think we're pleased, with that message. At the end of the day, you do have to select securities, but with regard to the battle between, do I want to be in the growth camp or the economically sensitive, I think you want to own both. And we'll want to continue to through the end of the year. And here you see the numbers for international. They were up high single digit, so they participated. And then you got really the wow, eye-popping numbers. You can see the S&P 500, that 96% return that you mentioned. So almost a double, and then small cap stocks more than double. So you're kind of at that point where you can say, wow, it's been wonderful, but does this foretell gloom and doom for going forward? And we would say no. And it's not because we wear rose-colored glasses all the time. It's discussions that we constantly have about the fundamentals, the valuation levels, and the technicals, and we call them the F, V's, and T's. And we'll go through them in chart form, in a little bit. And, I know you'll keep me honest so that people can see the metrics themselves. But when you sit back and think about it, earnings and the economy are robust. Employment trends remain very positive. We just had an 850,000 new job payroll report that came out recently. CEO confidence, small business confidence continues to grow. Capital spending is up. So when you look at the fundamentals, it's hard to be negative. And in fact, we label them as positive. And yeah, they're going to slow. But, as human, as a human race, we're negative people. And you get that negativity bias. And I think folks constantly worry that, they're going to slow to weak. And we think they're going to slow to still healthy levels. When you look at valuation, I'm sorry, the 10-year Treasury is not trading at 6%. It's at 1.5%-ish and about equivalent to the dividend yield. So while 22-time PEs are not the norm, neither are bond yields this low. And so bonds and stocks compete for attention. Stocks still look good on that basis. And if you look at the equity risk premium, that, the earnings yield less the bond yield, it was negative back in 2000. It's nicely, handsomely positive at over 200 basis points right now. So valuation we think is reasonable. And then the technical price trends remain favorable in the fact that most stocks are in long-term uptrends. The number of stocks advancing versus declining just looks fine. It's not breaking down and rolling over. And so from a technical standpoint, while momentum has slowed a little bit, it looks good. Now that said, we'll get into, we do think that a pause or correction because of the wall of worry items that are out there, because of this nice run that we see in that column right there, and because of this little ebbing in momentum that suggests that maybe the market, and we listen to the market, wants to take a bit of a rest, it wouldn't be unlikely to see us pause before we move to higher highs, and we'll introduce, our higher price targets by mid next year. But yeah, I'm just piling on, what you just said.
Well, thanks for backing me up there. I appreciate it. So maybe now you can explain our thoughts just in general around corrections and how to best address them if we do see a rising probability of either a pause or a pullback.
Sure. So I love this slide that I know you're going to queue up in a second. It's very helpful with clients to show, the intra-year corrections around calendar year returns going back, 50 years or so, 40 or 50 years. Here we go. It's right here.
Yeah. Sorry, I was having a little bit of a tech issue over here. Should be
I tried to slow that down a little bit.
I appreciate that.
So I know a lot of people have seen this before, probably used it with clients, but I do think it's really telling. So here you have annual returns for the S&P 500 going back a long, long time. And you can see when the gray bars were moving up and they're in positive territory, the S&P 500 is profitable. And then when they're going down, those are years in which you have losses in the S&P 500 or the S&P 500 is down. And the red dots represent intra-year corrections. And, if you look at 2020 as an example, you had over a 30% correction in that red dot in that year, and yet the price return was 16% and the total return was 18% for the S&P 500. So corrections are just, part of life and part of the norm. And I think the difference, what we try and really do is separate a correction period from what we think is a market top. And while we think it's likely that we have a correction, and by that, what I mean is generally corrections, the environment that describes a correction is psychology gets negative for some reason. People worry about the headlines. They worry about accelerating inflation, or they worry about peak data. And I don't think that's anything unlike 2016 when people started to freak out, if you will, about Brexit. And they imply from the headlines, not only do they just worry, but they imply that that's going to negatively impact the economy and earnings. And back in 16, they said Brexit was going to cause a global depression. Well, that didn't happen. And when you look at, the Trump election around 2018 and subsequently the tariff kind of rhetoric that came out, and folks worry about the Fed back then. So we're going to have a recession. Oh, the yield curve is inverting. The yield curve is inverting. And it did for a nanosecond, but the data, the fundamental valuations, technicals were positive. And then in 2020, it was all about the pandemic. And yet we had all this stimulus that actually kept spending and income levels and bank accounts at fine levels. And the FETs looked solid on that basis. So, corrections are emotional periods. They're part of a normal kind of just event that happens. And it doesn't mean that calendar years are not going to be positive or the next 12 months are not going to be positive. It's just overreactions. And the last thing you want to do is suffer whiplash, a la 2020, get out during that 30% swoon and give up the 100% or the 96% that's to follow. And that's based upon the actual data itself that comes out that shows that, hey, we're in the midst of a V-shaped recovery. So, this doesn't call for action, but I wanted to get it out there that just because we think there's a correction doesn't mean that we're going to have massive activity to guard against it. That can be a money-losing proposition.
Sure. No, I think that makes a lot of sense and is obviously very important to highlight and point out there. And just real quick for the audience, I see a couple people putting questions in there. Awesome. Appreciate that. I'll just ask everyone to continue to do so. And then when we get to the end of the prepared slides, we'll go through and answer as many of those as we can. So appreciate your participation there. So Jeff, if we think that FETs remain constructive, can you talk a little bit more about why do we sense a correction could be likely or on the horizon?
Yeah, and I do think it's the three reasons. Some of it has to do with just technical price trends and activity more of late. The first two reasons are simply, hey, we've run really hard, and sometimes people just need to take a break. The second thing is that there are wall of worry items that we're going to be reading about and continue to do that as Chairman Powell is out there talking about, are they going to hike? Aren't they going to hike? Is inflation transitory? Is it not transitory? And that type of thing. So those fears alone, as inflation numbers come out, could cause some volatility. But what we've really seen more recently on the technical side, if you look at momentum that's measured in different ways, here we're just looking at, in the blue line, is the percent of S&P 500 stocks that are trading above the 50-day moving average. You can see that trend that's going down. If you look at the percent that are trading above the 2-day moving average, it's still held pretty solid at close to 90%, but more recent momentum has come out a little bit. And if you look at the number of stocks that are hitting new monthly highs, that also has ebbed down to the 20% level or so. So that's come way in. And it just says, maybe people are a little tired and the market wants to kind of chill for a bit. So that would suggest to me that, maybe there's some chop, maybe there's some rolling corrections by sector, but, not looking for maybe brisk returns over the next 6 months or so. And I don't want to get too cute, but, we're just trying to look at the data.
Sure.
The chart that you see up here, also from a leadership standpoint, shows that if you look at high beta versus low beta stocks, this is another thing that we look at. What is leadership like in the market, both from a sector standpoint and just from a more aggressive standpoint versus a defensive standpoint? High beta was really ripping during that period from March 2020 through the first part of this year, and now we're kind of moving sideways. So again, a little bit of excitement has come out of the market. Another reason to think that pause, correction, whatever you want to call it, I think is increasingly likely, and we're kind of looking at this.
Yeah, no, I think that's helpful, and it also helps just remind everyone of the work we really are doing, or you and your team are doing, to try to figure out the differences of the signals between what might be a pause and what might be a longer, uglier potential bear market situation, which we'll come back to a little bit later on some of those points as well. But for now, maybe let's head into just the historical data and what can that tell us about how markets have historically responded when we have experienced a first strong half that we've seen like we have so far this year.
Sure. So it still comes back to the fundamentals and valuations and the technicals, but this is kind of a fun slide just to show you that historically, just because things have been good doesn't mean the party's over and you can't continue to have successful, healthy returns in the ensuing 6 months. We're saying, hey, we could have a correction, but if you just look at history and look how the market performs in the second half, I don't want folks to think, oh, it's going to be just a horrible second half. This shows you that this was actually the 13th strongest first half on record, and for the S&P 500. And you look at the other periods; these are the top 15 first halves that the S&P 500 has experienced. And the table down below shows you in the ensuing second half, after you've had these, good first halves, what does the second half really look like? And if you look at that far right column, 73% of the time, the second half is positive and the average return is around, 6%. So I just throw that out there for fun. Don't think that because we've doubled that, you can't continue to see the market go up, and it just has to, roll over. So just kind of some fun data.
No, it is fun. It's really interesting to look back at all that data and think here we are having another record year from a first half perspective, or one that we'll be looking at going forward historically as well. Before we move into our base case outlook and some of those alternative scenarios, can you quickly, earlier in the opening remarks, I talked about talking through what we did well and maybe what we could have done better. So I thought it would be good to move into that conversation and for you to highlight some of those things.
Yeah, and I think this is pretty self-explanatory, but we list, what, 4 things over there that we feel good about. Going in, you mentioned in your introductory comments that we thought we'd have a 13%, a double-digit return in the S&P 500, and that earnings and economic growth would be solid. Not everybody felt that way, going in to the year. And so I think we got that correct. We did list inflation in our crystal ball as a wild card item that could be topic du jour. No one was talking about inflation in December and January at all. And, we had Chairman Powell talking about accommodation to infinity and beyond. So I think that, we were thoughtful about that being a risk item. And so we studied a lot. Bill's done so much work on inflation and has really printed some good stuff. We do think it's going to accelerate, but believe that right now there's a lot of reasons to believe it will be managed in fine fashion, and it will ebb and moderate at higher but comfortable levels for the stock market. We thought rates would rise, and I guess we got that right, and we could have done a high five there for a bit. We were pushing 175, on our way to 2. We didn't think that would cripple anything. We kind of expected that and thought we would get good growth and that rates would come up as a result. And let's don't forget that rates were at 3.25% in November 2018. So we're still well down from where we were. And we thought domestic equities would outperform again. So, at the macro level, I think those were some pretty good calls that we had discussed. What we missed, and I'm not so sure that at the end of the year we won't be able to kind of slide this on over into the what we got right camp. Boy, you had value and growth, a big gap where the economically sensitive was really outperforming the growthier stocks. And, we didn't think that technology would tire like it did in the first part of the year. It came on strong in June and it continues to be that way. So we've gotten a little bit of a reversion, and now you got parity between the two. So we missed that early call. I think in some of our internal strategies, we weren't leaning as aggressively in that cyclical camp, and we were preaching balance. But I think that that's going to come around and be a good call for the year.
Thanks, Jeff. I think that's a great way to wrap up our discussion of what's happened so far, and maybe now we can shift gears and talk about what we see going forward. So I thought next you could take a minute to just outline our base case and some of the other scenarios we find possible this year.
Sure. So, we've got the slide and the display. Base case is outlined in green, and we've got the figures up there, and then we've got the expected environment that would support that base case. So we have 65% probability that we assign to an S&P 500 of 4650, and based upon where we were at the end of June, roughly that would be an 8% price return, a 10% total return, and that's predicated on a GDP environment calendar year of about 6 to 7% real GDP growth, slowing to half that rate or a little less in 2022. But solid GDP growth. Federal Reserve that refrains from hiking for the first half of 2022, continuing to support the market, but rates that do kind of push up reasonably. They don't surge, and so a calm but rising interest rate kind of environment. And in that environment, we think that you can maintain that PE multiple of roughly 22 times earnings. I don't think you'll get contraction, and we adopt consensus earnings somewhere around 211. They've come up a little bit recently to 213 or so. But if you look at that environment, you get the 4650. Now, there is a slight chance, like this year, that we get trend right, but that, and I don't want to emphasize that there's a slight chance that we get trend right. There's a slight chance that you get optimistic case, which is higher. and we assign a 10% probability to that, and that's 5,000. I don't know, when you say 5,000, people tend to kind of go, that sounds a little crazy. You know, when you hit a new level like that, that would be a really strong return. And what would get us there? That would be multiple expansion. That's where inflation would be more benign than feared right now. And, you know, this whole idea of peak data, folks get very comfortable that, wow, it's really slowing to a decent level, and maybe some things going on in Washington and tax policy is not as damaging to earnings in the economy as, you know, the headlines make us think. So you could maybe get a 24 handle on you know, PE at that basis. Stranger things have happened. I would kind of call that a blow-off type of top. I think that we would probably reassess at that point what we thought about valuation, because 24 times is pretty full, clearly. But I do think that you know, there's a 1 in 10 chance that, you know, we are really surprised on the positive. Now, we've got some disappointing cases that are in there. And the first one would be if you went back to that JP Morgan chart and you looked at years in which we had down years, those gray bars, you know, 80% of the time the market's up. So it does pay to be an optimist in this market. And you really need negative FVTs to take you negative. And we don't have them right now. When the market does surprise to the downside, generally you see 5 to 10% declines. You don't generally see, you know, 20 and 30% calendar year declines. So it's very possible that there's just disappointment. Earnings are a little bit lighter because inflation's heavier and margins are a little lower. You get a little multiple compression as inflation's higher, and you get a kind of a normal year in the market. We assign a 20% or 15% probability to that, I believe, or 20% probability to that. And then we have a 5% probability that, the Fed's behind the curve and inflation is anything but transitory, and you get a little bit of a stagflation type of environment. Very low probability that we see that happening based upon the data that we see today. But you could see what would happen if the market did that, and you'd approach a far lower level in the S&P 500. So we're confident. I mean, you got 75% probability here of another constructive year. And I would emphasize, so that, you know, people don't think that we're being foolhardy, you know, the big belief is that we'll have good returns, not stellar returns, but kind of a normal year in the market, 8% or so price return.
Sure. No, thanks, Jeff. I think that's helpful to walk through those different scenarios and the thinking behind them. There are a lot of folks that point to, you know, really bubble-like price behavior in the meme stocks, and then you already mentioned the S&P valuation being at 22 times earnings, and they point to those signs that indicates that we are at a market top. And in the opening comments, I said that we don't see signs of a market top at this juncture. So I think it would be helpful if you could walk through why we don't believe we're at a top today.
Yeah, and that is, again, separating correction from market top. Market top really is based upon the data. A correction is based upon emotions, you know, and headlines where the data continues to be strong. And that, you know, going back to 18 for just a second, we were outrageously bullish because the data remained positive while the sentiment and the fear increased dramatically. And that's an opportunity. A market top is generally based upon real data that's rolling and breaking down. And on all these 9 things that we look at here, if you went back to 2007, 2008, you could pretty much put an X by each one of those factors. You now have only, you know, you have some heavy IPO activity, and that's about the only thing that you would point to. If you know, some people might argue that if you've had a double in the S&P 500 off of a low, that's a blow-off top. I would argue that, you know, that's after a 35% swoon, and you know, part of that was just making up for some really tough times. So you could put maybe a yellow there if you wanted to. But all these other factors, heavy inflow into equity, money market funds and ETFs, not happening. If you look at some of those other factors on there, earnings rolling over, credit spreads, moving out, leadership going defensive, none of that's happening. And so if we look and, to keep me honest, let's look at the equity funds flows. You see the table on the left does show that we've had in more recent months positive flows into equities at a nice level, but still on a 1 year rolling basis, which is what's on the right, we're still, not seeing heavy net inflows into equity funds. That doesn't look like it did back in, 2000, for example, when, your grandmother and the barber and everybody, was in. So that's an example of one of those 9 items that, I wouldn't put in the X category. This next slide that we're going to look at, if you look at rates, yeah, they've come up from 0.5%, if you look at the 10-year, to 1.5%, but, look at where they were just back in November of 18. I mean, they were 3.25%. So the level is still low, and, they've stabilized to some extent right in here. So I think that, you want rates to come up that suggest growth, and we're not at levels that are scary by any sense of the imagination. The next slide, we'll get at credit spreads. The bond guys are far smarter than the equity guys. They just are. When you're battling for basis points, you really study hard. So if you look at credit spreads, they've remained uber tight, very low at historic lows. The credit market's not freaking out. And if you combine these last 2 slides, I would add on the inflation front that the bond market, you hear this talk about the bond vigilantes, that in previous Fed rate hike cycles, the bond market led the Fed, and rates started rising pretty significantly. And the bond market was worried about inflation. It's not now, and that's what gives us, I think, confidence that it will be managed, I think, adequately at this point in time. We'll watch that. We'll see what happens. But credit spreads look healthy. The next slide gets at leadership, and that does not look like a normal leadership board if you're at a market top. And you can see on the right, the laggards are staples and utilities. They would be in the leadership board. If you go back to 07, 08, you look at Colgate, Palmolive, Procter & Gamble, Kimberly-Clark, Duke Energy, they were leading the way as Lehman and, AIG and Johnson Controls and Deere and Cat were just choking. So this is not your typical leadership board, which is showing that there's still an appetite for risk in the market. That would suggest we're not at a market top.
Yeah, no, I think all of those, going through some of those in more detail helps to paint that picture a little more clearly now. So we've already mentioned that the F's and T's that we follow, that those really give us they remain positive, and that's what's giving us the confidence that we really do have more room to advance. And so I think we should move into those a little bit more so you can describe that in more detail and show the data that we follow.
Sure. So I said this before, this is what I call kind of our yoga chart. And, we've had a number of panic attacks going back to 2009. And, we mentioned pandemic, Brexit, the tariffs, oil has spiked or actually, swooned significantly. And so you have all these different panic attacks where people worry. And when you look at this page, this is what calms us. And we really, as you know, Katrina, look at this on a regular basis. And it seems overly simplistic, but these are the 3 levels of analysis. Fundamentals are comprised of looking at the economic trends. And by the way, under economic trends, we're looking at, 15 different things: trend in real GDP, consumer spending, personal income, autos, housing, employment, all kinds of stuff. But we rate them overall as positive. Earnings trends are positive. Estimates have continued to come up. Fed policy is accommodative. Interest rate trends, we just went over. So anyway, fundamentals, you mix them in a soup pot, they're positive. Valuation, price to earnings, would look expensive, but if you look at the earnings yield based upon low bond yield, they look positive. So on this basis, we think that valuation is reasonably valued. And then if you look at the technicals and you look at various things like, advanced decline line, and, momentum in the market, if you look at long-term price trends, you would call them neutral to positive. We've got almost 90% of stocks trading above the 200-day moving average. And yes, momentum has slowed. So that you can't say it's just, a beautiful picture, but it's solid. So this is what in 18 kept us positive when the world said we were moving to recession and it was going to be a terrible year. And we ended up having in 19 a 30% year. This is what kept us favorable. This is what keeps us saying stay invested, as opposed to, market top or move away, extended correction. This is what we look at. And if it was red and I was saying stuff like this, then you all should definitely question what in the world is the investment team thinking. But there you have it.
I might have to select somebody else to join me on these calls if that were the case.
Yes. Glad I got invited to this. Yeah.
No, I think this is great, and it does give us confidence. But there are some real warning signs and things to still be worried about, and things that we need to monitor. So not to be the realist in the room that brings us down. But can you highlight our assessment of the wall of worry and our current thinking around those items now?
Yeah, and I think we've got a chart on that. So, again, you don't want to be mistaken as complacent. And it's okay to be complacent if the FETs are positive, but you don't want to be accused of not looking at all the risk factors that are out there. So we keep this rolling wall of worry going all the time, try to understand the issues, and those issues are listed on the left-hand side of this page. So, we're looking at the new strains in coronavirus and whether or not we think that will, lead to some type of shutdown 2.0. I think the key things are right now in the news that our clients are reading about are inflation and peaking economic data. And then you see some of these other items. So number one, we like it. There is a wall of worry because we think it keeps folks honest and concerned, and you haven't had a blow off top yet. But what we really worry about, and not only trying to understand the issues and think, can they be adequately managed, is what is on the right-hand side. And I would have said the same thing back in 18. You would have had tariffs and you would have had Fed policy mistakes. But when we looked at economic growth, it remained positive, employment remained positive, earnings remained positive, rates were low, credit spreads were tight. So that, again, is what it all comes back to. And we'll show you, I think, our thoughts on a couple of these key items and what makes us think that they'll be adequately managed as we continue to monitor this stuff on the right and see if they're impacted. And we're going to show you stuff on the right and the trend in that data that, again, keeps us thinking this is a supportive backdrop and not, suggestive of bubbles and troubles and market tops and that kind of stuff.
Yeah, no, helpful. And I'm glad that you went ahead and offered to go into more detail because as the trend has been in the questions so far, I do think it would be helpful for folks for you to highlight again some of the data that addresses both the headline risks and then as well as the data that we really depend on to help us continue to come up with these conclusions.
Yeah, we didn't want to just do the trust me factor here.
No, never.
So yeah, if we do look, I think we'll explore maybe, first of all, this idea of peaking data some of it is based upon, well, how about this fiscal policy cliff? And this shows you the U.S. budget as a percentage of GDP. Another way of looking at this would just be looking at the extra fiscal stimulus as a percent of GDP, and that's actually a different number, but they tell you the same thing. And that is, you had a big jump in 20 and 21 in terms of spending as a percent of GDP. The question is, as we face this fiscal cliff, what was spending back in 19 and 18 and 17? And is spending being cut to levels that are not normal? And the answer is no. So while this extra stimulus is going away, you know, to me, it would be a concern if spending fell to historic low levels. It's really just going back to normal, and it's doing that at a time where the economy is opening and employment is moving up, and people are spending on services, and they're traveling, and they're going on open table. Even, you know, I'm a little bit of a tech Luddite, but I use open table. And you know, I don't think it's an uber concern, even though folks are going to read about, oh my God, all the stimulus is going away. Well, it's doing so at a good time, and it's not doing it doing so in a fashion that, you know, we're being draconian in our spending. So I just wanted to provide perspective on that.
No, I think that's great.
Then on the inflation front, you know, this shows you how CPI has spiked, and we're getting readings, you know, 5%-ish at this point. So you know, decade highs, if you will. And I guess there are a couple things. We have a chart down below, and everybody's probably read, if you look at the Wall Street Journal, or you just, you know, are looking at news online, that 30% of that CPI number was from used vehicles, you know, alone. And so you had airline prices, menu prices, this stuff that actually, you know, went negative. You had deflation. They're not back to levels that we had seen pre-pandemic yet, even though they're spiking in a big way. And the used car market is moving up in a big way because of this semiconductor shortage that we've all read about. And so new car prices are going up. That's pushing used car prices. So I do think there's influence from these certain categories. Bill's talked about that. And some of this just is definitively transitory. Some of it's related to supply chain issues. Some of it is related to labor shortages that will anniversary, and these issues will anniversary. So to think that this is going to be a wage price spiral, I think it's getting ahead of ourselves, and we don't think that it's appropriate to go there. With this kind of economic growth, inflation likely rise over the next 12 months and be at heavy, of course. But we do think that it will provide a little bit of a rest as we anniversary some of these things and slow to levels that are still supportive of healthy earnings. And what we like also is, I think we've got a slide on labor productivity here. This really does allow wages to rise, but keep unit labor costs intact if you have each worker being able to produce, you know, a lot more per hour. So we like the trend. So we think this is also an offset to what you're seeing in inflation in certain areas. So those address some of the issues, right? That get at inflation. And what about this fiscal cliff and about fiscal policy, and are we making mistakes? Then you have the right-hand side of the equation, and you're talking about earnings trends and what they're doing. And I just wanted, you know, to show you how robust earnings have been. And this is just forward earnings estimates and how they've come up for 2021. You can see that going in to the year, expectations were for far lower earnings growth than we're getting right now. we're looking at 37% earnings growth for the year. And while it's going to slow in 2022, that's slowing to still healthy levels. Tax policy could knock this down a bit, but I really think that it will be more moderate than worst case expectations are out there. And so I just want to show you how robust and strong, earnings and earnings revisions have been this year, and they're still solid next year to support this kind of 4,600 case that I talk about. And then we've got a plethora of stuff in here that just, again, it does away with the trust me factor. This is the ISM manufacturing data and the service level data. When you get worried about market tops, the blue and the green line on the left, it gets at manufacturing activity and service level activity, they fall below 50. Anything above 50 says that those sectors are expanding. And you can see they're above 60. And they've slowed a little bit, but they're still at really healthy levels, far away from what you see at recessions or market tops. Look at CEO confidence. And I think that's helping to drive the capital spending cycle, which is helping drive productivity. So, the data on this front looks good. I think we have just a couple more slides on this. Small business optimism has recovered and ticked up, at a nice level. Here you see, both because of CEO and small business confidence, you got CAPE spending that's coming up nicely in more than V-shaped recovery fashion. And then, okay, this gets it, we're starting to fly, we're starting to stay at hotels, we're eating out, and I think everybody knows this, but, all the growth had been really in the manufacturing sector, and now in pretty short order, folks are getting out and about now. And so this really is a positive for, for the economy. And, on the labor shortage front, it's interesting. I have some family that are in the hotel business, and they've said, that it's been hard even to get cleaning staff, and they were having to pay, $15, $16 an hour and still couldn't get people to clean. So they've cut back on cleaning. Now you've got a situation where unemployment benefits are going to anniversary, and it sounds like folks are coming back into workforce, and that should be a positive for inflation, while these businesses, his vacancy rates have gone way down. So, you kind of have a win-win on that front.
Yeah, but looks much different than it did this time last year for sure, which everybody has reason to celebrate for that. Sure. Now we're going to switch gears a little bit and kind of switch topics for a minute here. Obviously, earlier this year, significant rotation from growth to value stocks. So can you talk a little bit about how we feel about portfolio positioning on this front?
Yeah, so here you just see a long-term chart on value versus growth, and you see periods where, you have extended moments where one outperforms versus the other, and then you have, a number of moments of head fakes where it looks like, value is going to be off to the races, and then it swoons. And, when we look at this, we see really the driving force in today's economy shifting to innovation. And you see that both in growth and you see it in value. And rather doing this, growth or value, Aptiv is an example of a stock that we own in some of the internal strategies, which is an auto supply company, but it makes all kinds of software and components for advanced driving mechanisms, and is growing at a 20-25% clip as a result of that. And you see things like 2.6, which is an industrial company, but it makes silicon carbide, which the tech companies use for power management, just far better than just silicon. And you're seeing 20% growth rates in an industrial company, if you will, that is part tech company. But it's innovation, I think, that is the key. And we find that both in growth and value. So we would be balanced, and it would be really that ability to innovate and have this cutting edge technology that drives us, not, oh, do you want to be economically sensitive in traditional value or growth?
Sure. And then what about domestic versus international?
Well, if you do want cyclical exposure, a great place to get it is in the international area. And what we did was just highlight, we show you here the sector weights in S&P 500 versus EFA, for example, and have put gray bars around those areas where you've got huge differences. So you can see that the S&P 500 is much more growth oriented, with information technology at 27% of the S&P, communication services, which is where Google and Facebook and Disney, those types of companies, are housed, and that's a big part of the S&P. If you want some economically sensitive exposure, EFA, you get far more in financials, you get far more in industrials, and a significantly far greater amount that are in materials. So that international exposure that you get is a great way to provide balance in the portfolio and get your value exposure. Just wanted to make people aware of that as they, embrace some international in the portfolio.
Sure. Thanks, Jeff. I really appreciate all of those comments and the detail that you went into to really set the stage a little bit more for what we do see, what we're watching and what we anticipate seeing over the next 12 months. This is not a mistake of showing you all a slide that we already showed you previously. It's more so wanting to, end on a very important thing we think to keep in mind. As we said earlier, the stock market does advance most of the time, so it generally pays to be in the market at the right allocation, obviously, for you. So our goal today was to really just show you some of those things that we're monitoring. We feel good about where we sit today. We'll obviously continue to monitor and update you, as things continue to unfold. I know that we've got about 5 minutes left. My intention is to go ahead and try to answer as many questions as we can. We'll probably maybe run about 5 minutes over if you have to go. Don't worry about hopping, and then we can always follow up on any other questions that we may not get to here while we've got you all today. So Jeff, maybe you can just talk a little bit first on, as we think about a possible correction, do you have any indication or any thoughts around, will that be short? Will it be longer? Just any thoughts you might have around what a correction could look like if that occurs?
Yeah, so just in general, the thought of a correction is that it's not a, multiple quarter, multiple month type of affair, and it's more moderate in tone. So, corrections, anything over 10, it's kind of 10 to, 19% is, considered in correction territory. A bear market's 20%. I think it's magnitude and duration that makes the difference. And it also, those are centered around recessions. And I think that's another thing. It's the data that truly does roll over, that it creates an extended period. So we don't see recession. And while I can't be, a real soothsayer Swami and say it's going to be, 2.3 months is our target for the correction, and it's going to be 11.2%. I do think that it should be more moderate in tone. That said, we had a 30% correction in the pandemic before doubling off of that. It lasted 3 weeks. My feeling would be, because the data remains positive, that it would be similar to what we saw in 16, 18, 13, 14, where they were relatively short and relatively, modest, in that kind of 5 to 15% range. But if it's 16 or 17 and, it lasts not 3 weeks, but, a quarter, the market will do that. It's not something that I think is actionable, because I think you could suffer whiplash based upon the fact that the data still looks solid, the FVTs look solid.
Thank you. This one is a little bit more or heading into just how do you, the stock selection process. And one of the questions is, you know, what variables are you really looking at to determine what company you may invest in besides beta?
So we actually apply the same discipline to individual stocks that we do to the market. And we look at those same three levels, but we look at different stuff. So we look at fundamentals, we look at valuation levels, and we look at technicals. And as a matter of fact, once a quarter, it's almost like fantasy football. Independently, every person on the team, just like you would, you know, maybe ascribe a score to a player when you're going into a draft, we do the same thing for stocks. We actually rate them on a scale from, you know, 1 to 3 on the fundamentals. And what we're looking at there are things like trends in market share, competitive edge, and is it sustainable? That could be technology or it could be cost. We look at trends in earnings and earnings revision or earnings estimates coming up. Are they going down? You know, you are looking at, of course, the standard things like, you know, balance sheet, and then we really look for catalysts. You know, you can review historic information, but you're looking for catalysts to drive inflection points in earnings. So, you know, we're looking at a whole gamut of fundamental factors, some of which can be captured in the metrics, some of which you just need to talk, you know, with management and study product and positioning. We look at valuation. We don't want to buy, we don't want to pay up. Fundamentals may be great, but you don't want to pay up. And then we do look at technicals on the stock. So we don't want to catch falling knives. We don't like charts where you see you're in free fall. We like to see stabilization in trend, and maybe we won't get it cheap, see it hit support and hold. And we don't like to buy something that's coming into resistance levels. If you're looking at a stock that is still attractively valued with good fundamentals, but it's coming into heavy resistance, we like to see that it can break through that, and you don't get undue selling pressure. So those are the things that we tend to look at.
Thank you. What about, here's another interesting question. How much of current growth in equity total return do you think is explained just by the Fed's decision to keep short-term interest rates low? So how much of an impact do you really think that's having on equity returns?
Oh my gosh. Well,
$1 billion question.
Yeah, I do think that that has influence on confidence, and you know, the PE. I don't know how to ascribe some kind of factor there. I think that when the Fed begins to hike, no matter how well telegraphed it is, you're going to get a reaction in the market. You are. And that can cause a correction. But again, I think it goes back to the long-term fundamentals, the valuations, and the technicals. And I'll give you plenty of examples. And in fact, there's a chart that I saw with strategists that the market performs better than average during Fed rate hike cycles through the cycle. You get these reactionary downdrafts, but they actually outperform through that rate hike cycle until a certain point. So I think it's important, but I think it's earnings and you know, the other factors that ultimately are the reason that the market is up, not just Fed policy. So I'm dodging the answer just a little bit. I don't know how to describe it on a percentage basis. It's important.
No, I think it gives context to the question, and it was a little bit of a tough one that you can't really quantify it, but I thought it would be helpful for you to share your thoughts there. Yeah. Okay, so we're 2 minutes after. I'm going to ask one more question, and then I think what we'll do is follow up offline with any of you that still have questions that we didn't have time to get to. I want to be respectful of everyone's evening. So Jeff, maybe you talked about the fiscal cliff a little bit, but we did get a question about just, can you express more about what your concerns are as we talk about the budget deficit, just US debt in general, and the more printing of money? What negative impacts do you see that potentially having?
So,
what worries you about that, maybe, is the better way to ask it.
So I wrote a piece on this years ago, and it's funny how we're talking about the same thing. Now you've got maybe spending on steroids. We had stimulus back in 07, 08 as well, and people worried about the deficit. I look out 12 months, and my message back in 2007 and 8 was, buy stocks because we're in the midst of a cyclical recovery that could last for, a number of years. And the FVTs are positive. And people would say, well, wait a minute, we're going to be choking on debt. We're going to have a tax burden. We're going to be overregulated, and the consumer's going to be in a cave. And so the fear of all this debt is that people will, number one, that it's inflationary, that there's too much liquidity, and that our currency will lose credibility. And there's no evidence of that at this point in time. And we remain the reserve currency of the world. And if anything sneezes, people buy our treasuries. So I don't think it's something to worry about over the next 12 months. A fear of mine would be our debt structure. I think actually Bill has written a lot on this. So I'll throw stuff in Bill's direction. He could passionately probably talk about this, but we've got a lot of short-term debt. We've not extended maturity of our debt. So I think it really boils down to, if rates surge in a big way, then we've got a big problem just on covering interest costs. You've got to worry about even things like the credibility of our currency, if not our debt rating.
Yeah.
And those would be the big factors. But I just don't, near term, we're talking earnings and economic trends and valuation and that kind of stuff. And I don't think that the deficit's a big part of that equation. I worry about my kids and legacy issues, but I don't worry about that over the next 12 or 15 months.
Awesome. Great thoughts. Appreciate that. And I'm gonna call it a day here because there are a few more questions, but we will follow up offline. We'll make sure somebody follows up on those questions. But just want to thank you, Jeff, one more time. Appreciate you spending the time helping us walk through these details. Thank you to all of you that have listened in. It is our pleasure. It is an honor and a privilege to serve you, and really appreciate you all giving us that opportunity and spending the hour here late in the day with us today. We did have a question whether or not the presentation would be available after the fact or on the website, and we will be able to share a replay once this is complete. So thanks again for the interest, and I hope you all have a wonderful evening.